This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
Exciting week this week. We have new microphones.
I was going to say that. Yep. I hope we sound better.
I think it always sounded reasonably good, but these are nice new mics. So it's our first small step towards our studio, hopefully, in the next few months. Anyways, this is a long episode, so we'll make the intro quick. Big focus was on ESG investing.
I think that's it. Let's fire it up for the episode.
Fire it up, let it go from there. Some interesting things on fees too that came up from a recent article. And but it's a long one. But we went slowly so that you could appreciate all the research that Ben has done on ESG investing. So with that.
Well, it is at the very end. We had a pretty interesting discussion about where you should pay your fees from. So hopefully you can get through to the end because there's a good discussion there.
Thanks for listening.
Welcome to episode 82 of the Rational Reminder Podcast.
It sure is number 82.
Yeah, yes, it is.
So off the top, I just finished a book by Michael Lewis, The Undoing Project.
Hey, you've mentioned this book before, I think, as you were reading it.
It's a phenomenal story in a way that really only Michael Lewis, I think, can tell a story like that. I'm sure you've read maybe his past books like Moneyball or The Big Short or Flash Boys. He takes these events and ideas and stories and just weaves them into an incredible book about the impact that these two behavioral psychologists had, Amos Tversky and Daniel Kahneman. I know we've talked about for sure Kahneman in the past. He wrote the book Thinking Fast and Slow. Anyways, amazing story about how these two guys came together like in the 60s in Tel Aviv, I believe. And over time, they just became, Michael Lewis describes it almost like a love affair. They were together all the time, like 6 hours a day, every day for so long. And did you know that Kahneman spent time at UBC?
Oh, I did not know that.
Didn't know that, yeah. Between there and Michigan, as well as time in California. Yeah, it's an amazing, what these guys discovered and how they worked off each other to discover these biases that we all suffer from and heuristics that we have. And I saw a recent interview with Kahneman, even he said, well, this was Shane. He was Shane on the Knowledge Project. Talking about even he, after being a so-called expert on this for so long, he still falls prey to these issues and these biases.
Does he catch himself at least?
I don't think he does, actually. He doesn't think he has any greater insight than anybody else. You know, in some of the examples that they talked about, representative bias, people misjudge the odds of a situation all the time. Your judgments are totally distorted. You make serious errors. Availability, systematic biases that are caused by our judgment being distorted by the memorable things that we saw recently or we remember. Conditionality, that people don't know what they don't know. They also don't factor in their own ignorance into their judgments. And one of my favorites is the anchoring bias. And we've done this in a seminar a while ago where if you spin a wheel that has between 1 and 100 as an example, and depending on what that number comes up, that will often guide people into how they answer a question such as, what percentage of African countries are in the UN? So if you happen to have spun a higher number, you're going to guess a higher number for the membership level.
Fascinating.
And the book is loaded with examples, but how they discovered, I think it's fair to say they discovered this entire field of behavioral psychology. And, Kahneman won a Nobel Prize for that. But how they worked off each other to develop ideas and questions and tests. There's all kinds of risk profiling type questions, loss aversion questions that they came up with. And it's just how they interacted that just created this incredible body of research.
It's like a once-in-a-lifetime relationship kind of thing.
And to tweak the interest of Michael Lewis for him to actually, go ahead and write the book, quite something.
So you read like way more than I do, and probably way more than most people. And I know you always say it's because you don't have kids at home. And it's true because I spent a lot of my weekend playing with the new Hot Wheels track that we got with my kids.
See, I'm bringing my kids' Hot Wheels track to Value Village.
Oh, you still have it?
Yeah, help yourself.
You got the Hot Wheels track?
Oh, we have loads. Well, you have to negotiate with James, but yeah, we're loaded with stuff.
Okay, I'm going to talk to James after this. Carrying on, what I was going to ask you was, so you read all this material. How do you think about applying it to the stuff that we do with clients every day? Like you go and take in this amazing story about Kahneman and Tversky, and you reiterate to yourself all of these biases that you already were aware of, but now it's fresh in your mind. Do you take that and apply it in any way?
I think it gives me greater appreciation for where all these ideas came from. I think we do at some level. Something I thought about a lot lately is as you consume, we all consume so much material. How do you archive this and how do you recall this so it can be useful in these client meetings or even just day-to-day life? I listened to a fabulous podcast yesterday with Tim Ferriss interviewing Bob Iger of Disney. Incredible story, how he got to where he is. But what do you pull out of that? He gave a famous quote by Theodore Roosevelt. So it's to have the recall. How do you organize it? So I've actually, that's a question Tim asked him. And he says, well, I actually email stuff to myself. So he has a whole email folder. I'm trying to save ideas in my Evernote system and try to categorize them there. But it does become a challenge to organize and recall all this material.
Absolutely. Huge challenge.
So then I've got so many books and ideas backed up to read that it's crazy. I need more time. Anyways, on to the next news story.
Yeah, I thought this one was good. It was from December, so it's not super timely, I guess. But it was about CalPERS, the big California state pension fund, California Public Employee Retirement System, CalPERS.
CalPERS, the massive $380 billion pension system, largest in the U.S.
Yeah. So the interesting thing about it is that they have made, and they've been pretty vocal about this over time. I think they've just done another round of firing, but they're getting rid of a bunch of their external active equity managers and bringing a lot of those assets in-house. And when they bring assets in-house, a good portion of that goes into index strategies.
But it's incredible. So the most recent cuts, they cut the number from 17 mandates to just 3 external managers, and cutting that allocation from $33 billion down to $5 billion out of a $380 billion pension system.
It's crazy. And they're citing underperformance and they're citing high fees. And those things obviously go hand in hand. But it is interesting because and I don't remember which one, but there was a pension fund that I read an interview from, or the pension fund manager that I read an interview from a while ago. And they were talking about how active has been the best thing ever for them. And they've totally smashed the market. But you just think about the distribution of outcomes. CalPERS happens to be on one side. But imagine just the impact on the investing community in general if CalPERS had happened to fall on the good side of the distribution and had a great experience with active managers. That could shift the whole needle in terms of this wave of indexing. Like if a more vocal market participant or a larger market participant happens to have a good experience with indexing, that could shift the whole dialogue. But statistically, that's unlikely. And that's what we're seeing the statistically likely.
Especially on a portfolio of that size.
Right. And so we're seeing the statistically likely outcome. But it is just interesting to think about. There are some pension funds out there that have done well, or at least say they've done well with active management. They're maybe just not as big or not as vocal.
So according to Morgan Stanley, there's been about $1 trillion of assets that have left active managers. They say the long-term picture is also grim, as in the past decade, only 12% of managers have outperformed the broader stock market.
According to the Spiva report, you know what I'm really excited for? If it happens, and I don't know if it's going to happen, but I got an email from somebody who's in our business a while ago, and they were just saying, hey, like I've checked out your videos and I think they're great, and they're an active manager, but they wanted to say, what do you think of the Spiva report using A-class funds, which they do? And I've asked them about that in the past to confirm that's what they're doing.
A-class having the trailer fee built in.
Correct. So if the F-class fund without the trailing commission costs 1.5% just to manage the fund, there's an additional 1% cost that's designed to pay a financial advisor.
Did you say F-class at 1.5?
Yeah, just say you take an F-class fund at 1.5%.
Could they be that expensive? I guess they could be, yeah.
Yeah, well, you're used to the F-class funds that we see that are 30, 40 basis points. Actively managed F-class funds are still going to be 1.5%.
Done any of those in so long.
Yeah. So the challenge with the Spiva report using the A-class funds is that you're comparing the index, which has no fees, to active funds, which not only have active fees, but they also have trailing commissions for advisors built into them. And it's not a great way to do the comparison. Anyway, so I emailed them and said, kind of like, hey, we're an indexing firm in Canada and we would love your report, but it'd be awesome if you could run it like this, just to see how it changes the distribution of outcomes. Because those numbers, like that 12% of active managers beat the market over a decade or whatever, people always cite that, but it's using A-class funds. How does the story change if we use F-class? It shouldn't change a ton, but it should change a bit.
But as the article goes on, as you know, some analysts believe that this has to turn around. Another active management says they've been unjustly vilified. And that's so sad.
I can see you're feeling sad about it.
Because the thing is, it's more a testament to how bright these people are. That's the whole point. They're fighting the weak competition is being driven out, so you're left with the best competitors.
Yeah.
It's a tough game. A lot of very smart people.
But what you said is extremely true. It's like that $1 trillion that have left active managers, which active managers has it left?
Likely the weakest ones, right?
Probably the weakest, the least skilled. And the most skilled active managers are keeping more of their clients at least, which means the remaining active managers competing with each other for alpha are the skilled ones, which means that the skilled active managers no longer have unskilled active managers to exploit to generate alpha.
That's right.
So now they're battling with each other, these two ultra skilled managers.
Yep.
And then you've got the whole paradox of skill problem where those two ultra skilled active managers, say equally skilled, if they're competing for alpha, who's going to win on the trade on average? It's going to be determined by luck, by pure luck.
So I also like the article that we dug up from the Financial Times on January 12th, Vanguard to become the first asset manager to break the $6 trillion mark. I thought these are some interesting stats in there. So their net sales in 2019 were $268 billion, 16% increase over last year. However, for the first time in 7 years, BlackRock had greater sales than they did. So based on the sales of the first 9 months of 2019 at $300 billion, they're expected to break the all-time sales record of Vanguard, which they set in 2017 to be above $371 billion. But what is interesting to me is, can you believe where Vanguard's sales went? Only 20% went to long-term equity funds, 60% went to long bond funds, and 20% went to money market funds. So the CEO of Vanguard said that many of their 30 million clients became defensive after the rough patch in the fourth quarter of 2018, which many people will remember was a rough time.
Of course, it was a good time to take a defensive position.
Isn't it amazing though? Like a group who you would think would have, selection bias in their clientele with much more discipline.
Well, we know that index fund and ETF assets are being used. We don't know actually. We know to an extent they're being used for active management purposes. I don't know what the proportion is of how much is being passively held versus actively traded. I think you had a stat a while ago though showing that a lot of these total market ETFs, their average holding period is less than a year or something like that.
Oh, way less than a year. I think some of them are in the matter of weeks or days.
Right.
We looked at that.
So it's not like people are on average just passively buying and holding these things.
No. Anything else in the news front?
No, I think that's good for the current stuff.
On to the portfolio topic, which is socially responsible investing.
Yeah, this one's come up. Well, it comes up all the time. We've talked about it a little bit here and there in the past, but it's becoming an increasingly big deal. And we can see that just by the assets. So when you look at U.S. domiciled assets under management at the start of 2018, it's a bit old now, it's probably higher. At that time, at the start of 2018, 25% of all U.S. professionally managed assets were in sustainable strategies. That being a very broad term that describes all sorts of socially responsible, environmentally friendly, all that kind of stuff.
Well, that announcement last week by BlackRock was huge, I think.
It was a big announcement because BlackRock's a big company. We'll see how it actually shakes out. I think there was a lot of negative pushback on...
Oh, was there?
Yeah. I mean, the things that he was saying were not fact-based, a lot of them. Like saying that, which we're going to talk about, sustainable strategies tend to do better. False.
So there's the teaser.
Anyway, we'll talk more about that in a second. In Canada, the sustainable assets are about half of the managed market, that's a lot.
It's way higher than I would have guessed.
Yeah, $2.1 trillion in Canadian dollar terms. And that number is up 42% since 2016. So that's professionally managed funds in sustainable strategies.
In a sustainable strategy, not just holdings that are deemed to be sustainable.
Right. And you look at like the ton of the big Canadian pension funds have done things similar to what BlackRock has done, where they've said publicly, we're going to make sustainability an important part of our investment process. So this idea of socially responsible investing or sustainable, let's call it sustainable for the rest of the podcast, that concept is growing in terms of the assets under management. And that fact is extremely important, which we're going to talk about as we go through this segment. So as an investor, when you're thinking about should I build a sustainable portfolio or should I put sustainability at the forefront of my investment decisions, I think that there are a couple of main things you've got to think about. One of them is what is the impact on your expected returns, which is maybe an obvious consideration. And then the other one, which is probably more important and probably less obvious, is how sure are you that the thing that you're investing in, which may have an effect on your expected returns, a negative one, I spoiled it. How sure are you that this portfolio with a lower expected return, by definition, how sure are you that it actually reflects your views and values? Because you can go and buy this sustainable portfolio that's got the sustainable label on it, but there's a pretty good chance that it's not going to meet your definition of sustainability. And we're going to talk about why that's true. Sorry, I keep giving teasers.
Yeah, and how much impact it's really going to have.
Well, yeah, the impact thing is interesting. And I've got notes on that too. So maybe just to set the discussion, there are two main types, the two most common types in terms of assets of sustainable investing strategies. One is negative screening.
So taking out what you don't like.
Totally taking it out. And then the other one is ESG integration. So ESG is environmental social governance. In integration, the integration strategy, as opposed to totally excluding stuff, an integration approach changes the weight of companies. So the highest ESG ratings, the most sustainable companies, or whatever you want to call it, they get a higher weight in the portfolio, and the worst companies get a reduction.
So more of what you want, less of what you don't.
Right. And most ETFs, like if you look at a sustainability ETF, there's a good chance they're going to be using both strategies. Like it might be an ESG integration approach, but they've completely eliminated like tobacco or weapons or whatever. So in a lot of cases, it'll be both strategies going on at the same time.
And are most companies using a similar type scoring system?
Oh, Cameron, good question. We'll cover that in a second though. But it is a really good question, and it's a really important question. No is the answer.
Okay.
Sir, I guess I really thought through this topic, so I have it all structured in my head.
That's why I don't want to rush you. I know we got lots to cover here.
That's why I keep giving these teasers by accident. Okay. So if we talk about the effect on expected returns, and this is one of the most important pieces. Well, it's those two pieces together, I guess, that are jointly important.
But when we're dealing with clients, how often does that consideration come up compared to the desire to have an impact or reflect their values?
Well, I think it doesn't come up because people don't have the knowledge to even ask that question. What client that is worried about climate change is going to say, Cameron, will this affect my expected returns? That's literally the last question they're going to ask. But so I guess what I'm saying is that you're right. That's not what they're thinking about. But I think that's because there's a lack of knowledge. And that's why understanding the trade-off between expected returns and reflecting your values is important. And I just want to throw in there, I'm not anti-ESG. I think it's fine if you want to do that. But you've got to understand the trade-offs.
Right.
Which is the point of...
Well, you're just bringing the facts. You've dug through the papers, so fire away.
Okay. So if we think in broad terms of the effect on ESG scores on stock returns, that was examined in quite a bit of detail in a 2019 paper by Rocco Cicciaretti, Ambrosio Dallo, and Lamerjan Dam.
Look at you. You pulled off all three names.
Thank you. So they controlled for common risk factors. And I wanted to say this too. This is another really important point. If you don't control for common risk factors, an ESG portfolio can actually look really good compared to the market in terms of returns. Now that's important because if you take, say, just a regular market cap weighted index and compare that to an ESG index, the ESG index may have outperformed the market. Why though? It's because it has excess exposure to certain types of risks.
Luckily, all our listeners get that.
That's right. At this point, probably a lot of them do. So you'll often see like a loading to the profitability factor if you invest in an ESG index.
Reinvestment as well, perhaps?
I can't remember. It's been a while since I looked at I wrote a blog post a while ago on doing a 5-factor regression on an ESG index because somebody had written an article saying, look, ESG indexes beat the market. I was like, hold on. Did you run a 5-factor regression? Anyway, so in this paper, the paper that I mentioned, they controlled for the common risk factors. They looked at 5,972 firms globally, and they looked at the data for 2004 through 2018. And they found that companies with higher ESG scores tended to deliver lower average returns. So there we go. There we have it. Lower historical returns. They found a statistically significant negative premium for the ESG characteristic in a traditional Fama-French 5-factor regression. They also did a 6-factor regression, including momentum. And they did a 7-factor regression, including an ESG risk factor, which we're going to come back to in a second because it's important in a different context. So in all cases, they found that better ESG ratings in stocks produce lower expected returns.
And they included momentum.
In one of their regressions. They did a bunch of different regressions.
I'd be really curious to, just as an aside, think of the momentum going into these stocks now, if there's a momentum factor that may be happening.
That's a good question. One of the papers that I read did talk about that actually. If there becomes a quick, strong preference for ESG products, that can drive the prices of those securities up, which can make the returns look good, but only for a short period of time. Because once their prices jump based on the interest, their future returns are now lower.
Higher the price, lower the expected returns.
Correct.
Going forward.
Which is a theme all the way through this whole ESG conversation. So in the paper that we're talking about, they found that a 1 standard deviation decrease in the ESG score was associated with a 0.13% increase in monthly expected returns. So it's meaningful. So when they controlled for all of the common risk factors that I mentioned in those different regressions, they found the lower historical returns of the ESG characteristic, which is different from the ESG risk factor. The reason that the ESG risk factor is important is that they used exposure to that factor to try and determine whether the ESG negative premium is coming from an ESG risk factor or an investor preference. And that distinction is very important. in thinking about this. If it's an investor preference, and Fama and French did a paper about this in 2007 called Disagreements, Tastes, and Asset Prices. But they basically said that if investors have a taste, is what they call it, but if they have a preference that's not related to risk and expected returns for a certain type of assets, they'll be more willing to hold those assets regardless of their risk return profile.
That makes sense.
And if enough wealth is controlled by investors that have that type of taste, and this is why at the beginning of this discussion, I said that the magnitude of assets going into these strategies is important. If enough investors have a specific taste, like we're seeing with the sustainable investing movement, that can have a meaningful effect on prices.
Driving them up, you're saying.
Driving them up, reducing expected returns.
And that may be okay with those investors.
And that's an important part of this whole thing. But another way to think about this is that, and well, it's kind of like what you just said. The investors that have a taste for sustainable investments, well, this is kind of the inverse of what you said, actually. Investors that have a taste for sustainable investments require higher expected returns to be convinced to invest in an unsustainable company. So now we've got, just say for argument's sake, half the market.
Is that necessarily true?
Is what true?
Well, you're saying that if the sustainable investors are pushing up the prices of the securities they want, are they then setting the other non-sustainable investments prices lower, saying we're demanding a higher rate of return for us to invest in those just by them not going there? Or could you have a whole cohort of investors that say, I just don't want them, period, regardless of the expected returns, therefore leaving an opportunity set for other investors on the non-ESG investments?
So those are two different things. There's exclusion and there's investor tastes. And exclusion leads to an actual risk premium because neglected stocks that a large portion of investors will not invest in, like you just said, they actually become riskier. And one of the sort of main academics, I can't remember who it was, maybe it was Miller, anyway, or maybe it was Robert Merton. Somebody wrote a paper on that, on neglected securities having a risk premium. So if they are neglected, then it's still the same effect. The risk premium increases on the less desirable companies. If it's an effective investor tastes, so half the market is willing to invest in the bad companies, but only if the expected return is high enough, that drives down the prices of those types of companies. And I guess on the flip side of that, the sustainable investors are more willing to invest in sustainable companies, even if their expected return is lower, which drives up the price of those companies and drives down their expected returns.
Right.
Yeah. So I think based on that little bit there, we might have a bit of an understanding that based on investor tastes, it's reasonable to expect lower returns for companies that are sought after by the sustainable investing group, movement, whatever you want to call it. So then I looked at another paper also from 2019 by a guy named Olivier David Zerbib, and he developed an asset pricing model, and he included he included premiums for exclusion and investor tastes. So when you made that comparison a second ago, this is why I had an answer, because I read a paper about it. So he looked at distinctly what is the effect from exclusion. So what is the effect on securities that are completely excluded from ESG strategies? And what is the effect of investor tastes? And he was looking at it in the context of differences in expected returns. So he said that the premium for exclusion was related to the increased risk of stocks which are neglected. That's the thing we were just talking about based on that paper by the guy that I can't remember the name of. And then the premium for investor tastes is, and this is very specific language that came from a different paper that this guy cited, but it's interesting language. So the premium for investor taste is related to the cost of externalities that sustainable investors internalize to maximize their welfare instead of the market value of their investments.
Okay, let's run that one again.
The premium for investor tastes is related to the cost of externalities that sustainable investors internalize to maximize their welfare instead of the market value of their investments.
Right. So it's the amount they're giving up to feel good about their investments.
That's a very concise way of putting it.
Which is totally okay.
Like we said before, I have nothing against ESG investing. You just have to understand what the implications are. So in this paper, Zerbib found that the exclusion effect, and he looked at US stock data from 2000 through 2018, the exclusion effect, so the difference in expected returns between stocks that are neglected and stocks that are not, I guess, was 2.5% per year.
And that doesn't factor in any of the other factors in the Fama-French model?
No, all of these papers looked at multi-factor.
Okay.
Yeah, they're
So
controlling.
this is how much you're leaving on the table by excluding them.
Correct. So if you go
that's a big number.
deep down the path of ESG investing, I'm going to exclude all the companies that I don't like. In this paper, they found it to be about a 2.5% per year opportunity cost, I guess. And then the effect of investor tastes, which is associated with the idea of an ESG integration approach, that was 1.5% per year. So
That's
again,
how much you're giving up by focusing on that side of the...
correct. By weighting more towards ESG and less, and yeah.
Amazing numbers.
Yes. Now, one of the other really interesting things about this whole discussion, and it again speaks to that, the importance of the size of the ESG industry, but it's that the dispersion in ESG preferences is extremely important. And what that means is if everybody, all of the investors in the market had the same ESG preferences, the same willingness to own bad companies if the expected returns are high enough, and the same willingness to hold sustainable companies even if the expected returns are low, if everyone had the exact same preferences, there would be no ESG industry. Their products wouldn't exist, which means there's no dispersion in preferences. The industry doesn't exist. The differences in expected returns don't exist.
Correct.
If there's no dispersion in preferences. And this is from a paper by Pastor, Stambaugh, and Taylor, and they've written some other fantastic papers in the past. But they took a theoretical approach. The other papers that we talked about were empirical. And they found with their theoretical approach that firms with higher ESG scores have lower expected returns. No news there from the empirical stuff we've talked about. And those expected returns get lower when risk aversion is low and ESG sensitivity is high. So if risk aversion is low, sustainable investors are more willing to hold riskier stocks despite lower expected returns, which changes that difference in expected returns between sustainable and non-sustainable companies. Anyway, so that the dispersion and the strength of the dispersion is an important component of the differences in expected returns.
Whole lot to think about.
Yes.
I mean, this is going to be a longer topic than normal, but I think it's worthwhile to go through slowly. And I know we've had a lot of feedback from people that don't just rush through an in-depth topic. So I think we're going to try to keep going through this carefully.
I think we've been careful enough so far.
I think so, but it's
Should
going
I
to be
back up on anything?
No, it's going to be longer than normal. I think we're good.
Okay.
If someone really doesn't like it, they can hit the little fast forward.
The 30-second thing?
30-second fast forward.
Now, the other piece so we talked about expected returns. The other piece is social impact. And we're going to touch on expected returns one more time, but social impact for a second. So in the Pastor, Stambaugh, and Taylor paper, they found in their theoretical model that sustainable investing does lead to positive social impact by encouraging sustainable firms to invest more, which makes sense. We're talking about the cost of capital for these sustainable firms declining.
Yep.
Their required rate of return for investors to invest in them is lower because people are internalizing the positive externalities, while discouraging unsustainable firms from investing for the same reason. So their cost of capital is getting higher and higher. So now for an unsustainable company to invest in a project, they've got to have a really high expected return to make that investment.
Naturally.
Right. Which if you own that company, that's not necessarily a bad thing because your expected returns are higher. But if you're running the company, it kind of sucks.
Yep.
Which is the point. That's creating positive social impact. Now, where it gets tricky is that based on what I just said, you can affect social change with your investments, which is good. But the important part is that you are doing so at the expense of your expected returns. And I think that has to be true. And it has to be true because if there's no dispersion in ESG preferences, the thing that we just talked about with the higher cost of capital for unsustainable companies, if there's no dispersion in ESG preferences, that effect's not going to exist.
Right.
So for sustainable investing to work the way that you want it to in terms of social impact, it has to be true that you accept lower expected returns on a risk-adjusted basis. If that's not true, if you don't accept lower expected returns, then the social impact piece mechanically can't be functioning, can't be working.
I can see everyone kind of scratching their head.
Okay, well, you try.
No, keep going.
Well, how would you have explained what I just said?
No better than that. I'm just saying it's so counterintuitive.
I mean, for the whole thing to work, like why are we doing socially responsible investing? Maybe you want to feel good about ourselves. Maybe you actually want to have an impact. If you actually want to have an impact, and if that impact is going to work, it is going to work because you're getting lower expected returns.
More demand for the securities means lower cost of capital, easier to raise money, lower expected returns. Positive impact, change should come.
Right. You're encouraging good companies by giving them your capital. But if everybody is doing that.
Right. And if there's less demand for these so-called bad companies, their cost of capital has to go up, therefore higher expected returns.
Positive social change.
Which is why I've heard some people said, oh, well, I want to own those things and take those higher expected returns, then go and make a donation to make an impact. Because someone has to own all the stocks all the time. But anyways,
as I was going through this research, that's one of the things that popped into my head is like, if you decide that I'm going to be the sustainable investor and you accept that you're going to have lower expected returns, which I think must be true, both theoretically and empirically, if you're willing to do that, you're knowingly giving the people who by definition don't share your beliefs higher expected returns. And if we assume just from an economic perspective, that means they're going to have more wealth.
That assumes those companies survive.
Fair enough, yeah. I mean, if the portfolio is diversified enough, should be all right. But so if we assume that the people investing in the unsustainable companies are going to ultimately have more wealth, then they may also have more control to do things that maybe by definition of the difference in preferences you would disagree with.
Ooh.
Maybe they take their wealth and go buy another SUV and you paid for that. Maybe I'm pushing that too far. I don't know.
Maybe.
I don't know. Okay. So differences in expected returns is a big piece of ESG investing or sustainable investing. I said I was going to call it. But the other piece is that it must be less diversified than the market. That's a requirement. And that hurts from two perspectives. It hurts from the perspective that you own the part of the market that has lower expected returns. So you're giving up on a portion of the market that has a higher expected return. And you also have a fewer number of securities.
Therefore, reducing the reliability of your outcome.
So not only do you have lower expected returns, you also have a less reliable outcome. So it's kind of a double whammy of pain. And then fees are the other one, where like if you look at iShares has a suite of ESG products in Canada, and you could build a portfolio like a globally diversified index portfolio for 28 basis points.
Which is still remarkably cheap.
It's cheap, super cheap. But well, we'll talk about those products again in a second. People might shake their heads a little bit. But to do the same thing with an iShares ETF portfolio that does not have the ESG screen, you're going to pay 12 basis points. So it goes from still pretty cheap to like ridiculously cheap. But you're right. The difference is not
negligible.
Yeah, not huge. Now, the other piece, and this comes back to that reflecting your values idea, is that these things exist on a continuum where to get more hardcore ESG preferences, you must give up more diversification, and you're probably also going to have higher fees. Now, the big piece is that trade-off between views and values. So then you ask this question about do they use the same
filters, the same ESG filters or framework?
And the answer is no. So this is again a 2019 paper. There was a bunch of papers on this, I guess, last year by Florian Berg, Julien Colbel, and Roberto Rigobon. And they looked at the ESG ratings from 5 prominent ESG ratings agencies. So these would be the agencies that index providers are using to build their index products. And they found an average correlation of 0.61 for ESG ratings, which is low. And for context,
I say that sounds low.
Yes. And so for context, I can't remember if this was from the paper. Yeah, I think this was from the paper. For context, Moody's and Standard & Poor's for their credit ratings have a 0.99 correlation.
Wow.
So there's a lot more subjectivity, it looks like, in the ESG ratings than there is in something like a credit rating. And the range, so the average correlation is 0.61 with a range between 0.42 and 0.73. Now, if we look at the MSCI Canada IMI Extended ESG Focus Index, which is the index that one of those iShares ESG Canada ETFs tracks. So I said we're going to come back to that product. So the index takes an integration approach combined with total exclusions for tobacco, controversial weapons, and producers of or ties with civilian firearms and businesses involved in severe controversies. So you got the integration, and then you got some exclusions. So one of the largest holdings of that index, and therefore the ETF tracking it, is Suncor, which is a Canadian energy company specializing in synthetic crude production from oil sands. And Suncor aside, more than 16% of that index is made up of energy companies.
I know sometimes you show that to clients who want to have this preference and they're shocked by the holdings.
Right. So then you look around and say, well, that kind of sucks. You look at FTSE, which is a different index provider that Vanguard uses. And FTSE's ESG indexes do exclude oil, gas, and coal companies. They don't exclude downstream companies like pipelines, but still better than no exclusion at all if that's your thing. Now, energy specifically is apparently, based on that paper I mentioned about how different companies rate stuff, energy is one of the biggest points of disagreement, which had an average rating correlation of only 0.29. So I guess no surprise that the indexes are treating it differently based on how the ESG rating agencies are treating it. Now, this poses two major problems. One of them is that what we've been talking about is that you as the investor might be investing in a product that you think aligns with your views and values, but it actually doesn't if you didn't look at the holdings. And that sucks. That's too bad. You're accepting lower expected returns for something that you would have been sad about owning anyway. But then the other big problem is that when we talk about that social impact piece, are you really having a social impact? If companies don't know which ESG behaviors are going to be rewarded in terms of what ESG rating agencies are going to say.
Oh, interesting.
Then right. So if I'm a corporation and I do, maybe my company does want to improve our ESG rating for whatever reason, maybe because we want our stock price to go up, maybe because we're altruistic, whatever. But if that corporation is using ESG ratings to try and improve themselves.
And they're getting mixed signals in the marketplace.
Right. So now investors are allocating their capital, or if companies realize, based on what we've been talking about, companies realize that there's a market impact of these sustainable investors. So they want to align with them, but they don't actually know what to do because the rating agencies are all giving mixed signals.
So interesting.
So that gets pretty messy.
Or you go back to the Suncor example, maybe they're the best of the worst in some people's eyes. Like you don't know perhaps what caused them to be included in that rating selection.
Sure. And that actually speaks to the way that I would wrap this topic up is that approaching sustainable investing, it's all about precise management of the trade-offs between the implicit and explicit costs that we've talked about and your specific set of views and values. It's all about managing those trade-offs. And I've spent some time talking to Tim Nash a while ago, and I have no idea what he's going to think about this episode. I don't know if I like it or not. He explained to me that his role as a fee-only consultant for people that want to invest this way, his role is 100% about managing trade-offs. So he takes his knowledge set and he tries to figure out how severe are your biases against these certain things. And okay, if they're extremely severe, that means your portfolio is going to look like this. It's going to be 3 stocks or something. That's obviously an extreme example. But then someone like Tim would be saying a 3-stock portfolio is pretty undiversified. So we might want to shift a little bit.
Yep.
But it's all about managing that continuum of what are your views and values? How closely do they need to be matched? And how can you do that in a way that is still diversified and still has a reasonable expected return that's going to let you meet your goals?
Some reliability and reflects your preferences.
Yeah. So I know that that was a big topic, but I think it was worth discussing. It comes up a lot.
It comes up a lot, especially now after the big announcement last week.
But I think that I don't know what other context you could have to think through that question of should I be a sustainable investor? I think we gave all the context. Maybe all is
we gave enough for now, I think it's safe to say. On to the planning topic.
Yeah.
Another one that you chose for this week. So spending from an index fund portfolio, which is, again, another question we get quite often. How should I structure my portfolio when it comes time to actually start living off of it?
Yeah. And I think there are 2 main things that it speaks to. One is asset allocation. So I think when people ask this question, they're maybe partially thinking about how should my mix between stocks and bonds change over time? Or even how should my mix between total market and dividend stocks change over time? I'm not saying that's what you should be thinking about, but that's what some people might be thinking
listeners know your point on that.
Maybe. Some of them.
And also some rules of thumb that I know drive us all crazy.
Yeah. So I think people are thinking about what should my asset allocation be? And then they're also thinking about how do I actually get the cash out of my portfolio, which I think speaks to that mental accounting, capital versus income discussion. On the asset allocation piece, I think, like you said, Cameron, the rules of thumb are pretty brutal, like reducing your equity exposure over time based on your age, like 100 minus your age, whatever it is.
Now, having said that, if you followed that, you did keep yourself out of trouble. I know some people that did follow that in 2008.
Yeah.
So it's better than getting in over your head with an equity allocation that you can't live with.
Yeah, for sure. And asset allocation is always going to be somewhat subjective. There's always that risk aversion piece that plays into it. But there is some interesting research. Some of it's actually come from Graham in our PWL Waterloo office on glide path investing versus constant equity allocation. And that research has found that there's no expected benefit to using a glide path. So that's consistently decreasing your equity exposure over time. There's no benefit to that compared to holding the time-weighted average asset allocation of the target date of the glide path fund. So if on average you owned a 60-40 portfolio based on your glide path, you could have just owned a 60-40 portfolio the whole entire time.
Stay 60-40 all the way through.
And been just as well off. Now, it doesn't mean your asset allocation should never change. Like I think that you can be. And we talked about this in the investing with leverage discussion that we had a while ago and in the YouTube video I did, where, well, in their suggestion, you're using leverage to get your future savings into equities as soon as possible. And then you're decreasing your leverage. And then you're finally, when that's done, adding in your fixed income. I think equity investors can do something similar where you have your aggressive portfolio for a period of time and then transition maybe near retirement. But just that glide path concept isn't necessarily what you have to do. I think changing asset allocation should be based on other stuff. Like if you have a windfall, that's a reason to change your asset allocation.
Or if you don't need to take on the risk, if you have enough saved up.
That's what I was getting at.
You have that preference, right? And to be aware, and we're going to talk about this, but aware of what your long-term financial plan is and the kind of volatility that you have a preference for.
But I mean, if you think about it, once you're at the point where you're making the decision that you're ready to retire, it by definition means that you have enough financial capital to fund your future expenses. Otherwise, you would not be retiring.
Correct, but you can make choices at that point to reduce the variability in your portfolio.
That's what I'm saying.
If you wish.
Exactly. Once you reach that point of capitalization, you can do exactly what you're saying. Now, I guess if you have more capital, which maybe speaks to the windfall point I was trying to make, if you have more capital, you can afford to take even less.
Or even more.
Or right.
You can go both ways, right? Like we have some clients that have way more than they'll ever need that have gone all equity because they can afford to. Even if it does fall by half, they're not in trouble, but they know over long-term higher expected returns.
So that speaks to the point of why rules of thumb are not useful for asset allocation.
Trade-offs.
Yeah. Okay. So the other piece of this question, I think, is spending policy, where people have this portfolio of index funds and it pays some distributions from dividends and interest, but that's probably not enough to live on. And I think this is why income investing in general is so attractive to a lot of people, is that you get this fixed amount, or not fixed, but you get this amount of income paid by distributions. And if that's enough to live on, cool.
And you're not selling stuff to make
and you're not
payment.
selling stuff. But having a spending policy as a retiree is a key part of retirement. And the spending policy should not be dictated by the dividend policy of the companies that you own.
That's a key line. Although people love dividends, we've talked about that forever.
They're not investment returns.
Don't let that dictate your spending policy.
Right. Dividends are not returns. So you've got to figure out how much you can spend from your portfolio. It's not something that we can give you the answer to because it's like one of the biggest problems in finance. I think Merton Miller might have said that. But you can use stuff like Monte Carlo, a model, to approximate how much you can spend. You can use historical worst case scenario analysis, like how the 4% rule is developed.
So Monte Carlo is basically stress testing your returns with some variability in those returns over your lifetime.
Yeah. If we simulate 1,000 lifetimes, how many of the 1,000 simulations did you not run out of money? That's Monte Carlo. But you can do the same kind of thing with historical analysis. So take all the historical time periods using US stock data or something, which you can get for free online. Anyway, so you can use those things to figure out what your safe spending rate is. And then once you know that number, you can spend some combination of income and capital, as long as you stay within your spending rule.
Correct. Because what matters is total return and variability of the prices.
Right. When a dividend is paid to you, your capital must decrease mechanically by the amount of the dividend that was paid. And so it's no different. Receiving a dividend is no different from making your own dividend and selling some stock. I just have to throw this into this discussion because it comes up on the dividend YouTube video that I posted a while ago. But when you sell shares,
ferociously comes up in the comments.
Like all the time. It's like, man, I thought I answered this already. But
it's not debatable. It's tautology.
Yes. So the thing that comes up that we're talking about being tautology is that people seem to think that if you reduce the number of shares that you own, which you would do if you're selling shares as opposed to receiving dividends. If you reduce the number of shares that you own, you're shooting yourself in the foot. You're now worse off. You're in a worse off position to accumulate future capital. If you think about an example, so if you start with 100 shares worth $1 each, so you've got $100 in your portfolio.
Of total value,
and the shares pay a 10-cent dividend. You've got 100 shares and they're worth 90 cents each now.
$90.
$90 portfolio, and you've got $10 in cash from the dividend. Now, alternatively, if you had not received the dividend because your shares didn't pay dividends, and you instead, same value for the shares, and you instead sold 10 shares to create a $10 cash flow because you needed some income, you would now have 90 shares. So instead of 100 shares worth 90 cents each, you've now got 90 shares worth $1 each. So portfolio is still worth $90. Now, in either case, whether you own less shares that are worth more or more shares that are worth less,
it's the same.
If the future return, like tomorrow, there's a 10% return, a 10% jump in the market, the value in both cases increases by the exact same dollar amount.
Right.
The number of shares that you own does not have any impact on your returns, especially now that you can trade fractional shares. Like, it really doesn't matter.
Correct.
It used to matter a little bit because at some point you would have to sell your last share, I guess. But with fractional shares, it doesn't matter now.
It's the number of shares times the current value that determines your portfolio value.
Yeah. I think just one more thing to touch on this income topic is that what a lot of people do to make it easier to think about is build a GIC ladder. So you've got 5 GICs maturing one each over 5 years. And the thinking goes that you can just spend those GICs.
And you don't worry about the market. So you basically give yourself peace of mind that you don't have to worry about the market for 5 years.
Right.
But that's not necessarily true.
Well, it's not true because when your GIC matures, you have to replenish it to keep your asset allocation the same.
Well, that's just it. So as you spend down those GICs, overall, your equity exposure, all things being equal, is increasing because you're reducing your fixed income.
Right.
And I can tell you very few people look at it that way.
Right.
They just compartmentalize it. I'll leave my 60-40 loan over here. And I'll have off 5 years of GICs in this other account.
Right.
Therefore, I don't touch. Well, now you're really at whatever, some other asset mix.
Now all of a sudden, 3 bad years in the market, and you're at 80% equity. And who's to say the 4th year is going to be good, not bad?
Yep.
Well, we've talked about this with Alexander McQueen a while ago, that the GIC ladder concept is basically irrelevant for that purpose. Anyway, and then the other piece of this that I think people struggle with, and this is one of the other questions that I get a lot on this topic, is that if you have a balanced ETF, like say you retire with VBAL and that's your only asset, there's this perception that you're required to sell stocks when they're down. Like if you think about it, if you owned 60% of your portfolio in a stock ETF and 40% in a bond ETF, if stocks are down, you can just sell some of your bonds for income to rebalance.
Yep.
And that's fine. You end up back with your 60-40 mix. But if you own VBAL, you have to sell stocks when they're down. But it's not, that's not how it works. If stocks are down, VBAL is rebalancing, which means
you've been buying all the way along.
Right. Which means, say it happens in a single time period, stocks drop. Inside of VBAL, they're selling bonds to buy cheap stocks.
That's right.
And then you go and sell your unit of the fund. You're selling the cheap stocks that they just bought. It's not like you're buying stocks low. You're buying them low. Selling stocks low. You're buying them low and then selling them low.
Yep.
But you're not losing out on anything.
No, in fact, you're going to have better tracking to the asset mix you wanted all the way along, as opposed to when you decide to take money out.
Yeah. So I mean, you figure out your spending policy, sell your assets as needed, use income distributions to...
And use Monte Carlo to find out the asset mix that's appropriate for you and your own preferences.
The asset mix and the spending policy.
Anything else on that topic?
Nope.
So we'll quickly go on to the bad advice of the week. This one came from a Globe and Mail article of December 18th, why investors should pay for all investment fees out of non-registered accounts. And this generated quite a bit of discussion around here, and we thank a regular listener for sending in the article to us. So I know you're listening, Mike. This goes back to a letter, I guess, from the recent Department of Finance Canada letter to CRA stating that paying investment fees for your registered accounts, your RSP or TFSA, out of your non-registered account, right? So have your trading account pay for your RSP and TFSA fees, does not constitute a tax advantage for investors. So therefore, the article says, therefore, you're now free and you should pay all your investment costs from your RSP and your TFSA out of your trading account.
Right. So you're paying fees in your RSP and TFSA, but instead of taking the cash to pay those fees from those accounts, you take them from your taxable account.
So if we go back to basics, any fees paid from non-registered accounts for that account are tax deductible. So your trading account, if it pays those fees, that's a tax deduction for you. But any fees paid from an RSP for the RSP are not tax deductible. They used to be many, many years ago, but they no longer are, right? Same thing for TFSA. However, you are effectively using pre-tax dollars to make that payment. That's the benefit of using the cash in your RSP to make the trustee or the management fee payments. Those are pre-tax dollars.
You think about it, we've talked about the RSP in the context of asset allocation. Like you should use the after-tax value of your RSP for asset allocation. Fees are calculated based on the pre-tax value of an RSP. So if you think about it, you have, say your tax rate is 50%, you have twice as much in your RSP account than you actually own, but you're still paying fees on the full amount. So you're paying fees on the portion of your assets that the government owns or is entitled to. And if you pay those fees from inside the RSP account, the government's paying half your fees and you're paying half your fees.
Right.
If you pay those fees with after-tax dollars from your taxable account or from wherever, you're paying your portion of the fees and you're paying the government's portion of the fees. And you're not getting a tax deduction for it.
Yeah. And
when you withdraw the money from the RSP in the future, you're going to pay tax on the full amount.
And that assumes that your service provider can partition those fees so they produce an accurate receipt. So that your trading account fees are deductible, but the RSP fees paid from your trading account are not deductible. So I'm not sure if systemically the industry can do that. Perhaps they can.
I'm sure a keen DIY investor could figure out how to partition their own fees out.
But still, it doesn't make any sense. Now, it does make sense for the TFSA. Right. To have your trading account pay for the fees as opposed to your TFSA.
Yeah, because in that case, you're paying fees on the after-tax amount. So you're not paying the government's portion of the fees.
It's after tax on both sides.
And the more you can leave in the TFSA to compound, the better. And we have to do a little bit more work on this because I'm not sure if there's some break point where it does make sense to pay RSP fees, like if you have a long enough time horizon.
Yeah, to compound enough of the fees that are left behind, but it'd be a long time if it does work.
Maybe it's 1,000-year time horizon, then the RSP, it makes sense to pay out of the taxable account.
The article didn't talk about the deductibility of the fees, and that's kind of the point of this.
If you Google around on this, nobody's talking about that. And I actually saw a post on Reddit that I responded to just because I read it and I was like, oh, come on, like I can't just let this one go. Because people seem to think that they could deduct all of the fees. But the letter from finance to CRA, which it's called a comfort letter, it addressed Income Tax Act 207.011, which relates to the advantage. So this used to be considered an advantage, the advantage of paying fees from a registered account. So they're saying that's no longer an advantage. You can do it. But it's a completely different section of the Income Tax Act that relates to the deduction of fees. So that's Income Tax Act 2120, bracket 1, bracket BB, which addresses the ability to deduct fees. And then the other piece that's important is Income Tax Act 18, bracket U, which addresses the limitation, specifically the limitation for deducting fees paid for services in respect of the RSP and TFSA. So 207.01.1, which is the thing that's been addressed in this comfort letter and that's been talked about, only addresses where you can pay the fees from.
Not the deductibility.
Correct. The deductibility is a completely different section of the Income Tax Act. Now, I'm not that confident in my ability to interpret the Income Tax Act, so I did ask one of our CPA friends, and he confirmed it. That's the way it is.
Okay. At the end of the day, looks like for now, use the RSP to pay the RSP fees. If you can't get the TFSA fees, typically they're much smaller, but paid for by your trading account.
Right.
And leave the trading as is for deductibility.
And we have a couple of our analysts working on building a more robust model so we can build some parameters around, like, does it ever make sense to pay fees out of for the RSP out of the taxable account? So if we find any groundbreaking conclusions that we didn't expect, we'll relay them to our faithful podcast listeners.
Anything else?
No, long episode, sir, everyone.
Great. Thanks for listening.